Let's talk about last week, guys. My name is Hamilton. I'm here with the Trading Initiative. In this week's Markets in Focus, wrapping up the week ending at May 9th, 2024, let's go through what happened, how the market closed on Friday afternoon. First things first, I want to focus on mid-caps. This is an area of emphasis inside of TTI. We've been buying smalls and mid-caps ever since the Russell 2K broke up and over the 200 area price level, and we're consistently seeing now for the second week in a row outperformance in smalls and mids. Is this the beginning of the next leg up, particularly in those two parts of the market, mid-caps and small caps? We are increasingly thinking yes, and we have started opening, and we already had exposure through the drawdown. We are adding more exposure here. We like the absolute and the relative performance here to the upside in mid-caps and small caps. We're going to look at that in a second in Trading View. You see copper up 2.13%. The S&P 500 up 1.85. The Qs up 1.51. And once again, the Russell 2K up 1.19. It was a pretty goddamn good week to be a bull. I do want to stress that it's not just 1 week now that it's been a good week to be a bull. Ever since the correction, we'll say, I can't even say correction because realistically it was only a 5% drop to the downside, was the lows were they placed on April 19th. It's increasingly looking like yes, they were, and we're going to look at that in a second on Trading View. We have been buying over the last 10 days or so, and those positions are coming to fruition. Realistically, the only area of the market that's not working well that we are still risk on in is crypto. Bitcoin is just doing nothing. It's not necessarily capitulating and kicking us out of positions, but at the same time, it's not continuing to show strength like the broader market is. And generally speaking, there's a pretty high correlation between Bitcoin and at the very minimum the Qs, right? Risk on kind of sentiment. And we're just not seeing it translate through. So we're not adding anything into the Bitcoin position that we have right now. We have a line in the sand. We're pretty far away from cutting it as a failed breakout into all-time highs, but we're doing nothing here. It's just underperforming. It's a little bit frustrating, but we're just going to sit on it and let it do whatever it wants to do while the rest of the market is starting to catch back up. So let's actually go ahead and look at that from a sector standpoint. Let's go back through the last month really quick. And I want to point something out here. First things first, people are freaking out about utilities leading. Totally understand that from an intermarket analysis standpoint. When something like a utilities sector is outperforming like a tech sector, so a classically lower volatile sector of the market and utilities outperforming a higher beta area of the market like tech, generally speaking, people are going to look at that as defensive in nature. That's definitely not considered classically risk on. But one thing I do want to point out is there are periods of time that they span years. It's not just like a quarter. But if you go back from 2000 to 2008, I believe utilities outperformed a bunch of different times, and that was technically a bull market. We were inside a secular bear, but it was a bull market. There are times when utilities can outperform. It's not necessarily the end of the world, but I want to throw a little angle at you guys, and I want you to think about this. I talked about it last week very briefly, but we had this conversation inside of TTI. The leaders right now in utilities, which, by the way, you're going to see tomorrow in the heavy hitters report coming out. So if you're not subscribed to the newsletter, the link is below. I'm going to send you a scan with the 30 strongest large and mega cap stocks in the United States right now that are setting up to potentially be bought. A bunch of them are coming out of the utilities area, the utility sector. The thing is they are not classically utilities based. They are nuclear powered companies, right? They own nuclear reactors, et cetera. And it's interesting to me to see these types of stocks inside of the utility sector instead of something like an energy sector. So right now we're seeing a lot of these nuclear energy companies and stuff like that outperform VST, CEG, some insane breakout and runs. But I need to ask you, could that potentially be an extension of an energy related trade and or the AI boom, right? There's whisperings right now that we need all of this extra energy production to go ahead and power the future of this AI bubble that we have going on. Utilities right now taking a commanding lead, and it's those specific stocks within the utility sector that are also weighted very heavily right now. If you actually go and look and dive into XLU, you'll see that the biggest stocks within XLU are those nuclear-based companies. I'm telling you, there might be something there. This might not be risk off like most people say. I think if that theory is right, by the way, and I have cash on CEG because of the breakout, not necessarily because of this theory, but I'm just thinking out about utilities outperforming in the broader context of a bull market. And is that scary or not? If this theory is right, I would expect these companies to continue to roll, right? The easy trade in the AI bubble is semiconductors. Everybody knows that. Data centers, stuff like that. But what happens if the unsung hero are the energy providers of the future? Could be. I have no idea. I could be completely wrong there, but we are long CEG. And it is a winning trade for us. So we got that going for us. Staples, though, don't love to see that. In a supposed second year bull market here, we don't want to see consumer staples continue to take a commanding lead, but that could still become some of the, it could still be like a hangover effect from the April 19th low. with tech and consumer discretionary communications playing catch up right now, which totally could be there. We'll see. I think we're going to look at this more in depth on Wednesday during our mid-monthly charting session. We're going to look at whether or not we should be afraid of the consumer staples leading, or if this is eventually going to pull back and we're going to see those classically risk-on areas of the market outperform again. As of right now, I'm not necessarily worried. We've been buying positions in risk-on areas of the market, and they are working, which we're going to look at in a second. By the way, I didn't say this, but big shout out to financials. Hopefully I remember to talk through that because I didn't write it down in my notes here. But financials are outperforming both domestically and globally. That's very important, guys. Financials leading is generally not risk-off market behavior. Go back over the last month and you can see, obviously, we came out of that April 19th low. Lots of recoveries. And although right now water resources outperforming at 3.51 and gold miners at 3.13, which we have a position in gold miners and it's working relatively well. It's not a huge winner or anything. Check out regional banks. I'm telling you, financials, there's something there. But look at some of the catch-up trades here in software and some of the risk-on areas of the market. You see IGV, Apple's a huge component of that. You see semiconductors are starting to catch a rally off of that April 19th low I was talking about. Semiconductors have almost entirely been bought back up to where they previously were prior to the drawdown, guys. That's huge. That's a lot of information for us. Then internet stocks trying to place a low as well. So we are seeing some rotation back into risk. It's not just run for the hills right now. There's definitely some risky behavior going on in the markets. And we should, by the way, see that translate into, specifically if it's smalls and mids, we should see that translate into small cap growth. And we're actually not seeing it, at least in terms of relative performance against the S&P 500. So there's a lot of people out there expecting small caps to outperform second half of 2024. I don't know if that's going to happen or not. I do know for sure that we're going to see it on this specific chart if that were the case. If small caps were going to outperform the broader market for, let's say, 6 months, we are going to see it on this specific chart first, right? The factor analysis portion of COIFIN. This is IWO against the S&P 500, so your small cap growth against the strongest and largest stocks in the market right now, as indexed by the S&P 500, and we're just not seeing it. So once again, if your thesis is small caps are going to outperform second half of the year, you're going to see IWO probably outperform SPY, and you're going to see it on the 1 month before it translates over to the 3 month, right? So you're going to be able to catch it early if it happens, but as of right now, it's nice performance, don't get me wrong, and we're buying small caps, but are we weighting them as market leaders through the next 7 months? I think it's a little too early for that, but still risk on behavior. We like it. Right now, the strength and the safety is still large cap growth. It has been pretty much all year. People are still buying this stuff. Mag 7 stocks like Google at all-time highs, Amazon at all-time highs. That's where people are still buying right now. You don't need to reinvent the wheel, right? You absolutely do not need to reinvent the wheel here. So I think it's important to know where the strength is and whether or not, we're in this risk off, type of mentality in the market. And I just don't see it, guys. I really just don't see it whatsoever. And so let's go ahead and flip over to TradingView really quick. And let me see if I want to, there's something I want to pull up really quick on the market research portal. If there's something there. I think we're good. Okay, let's get over to TradingView. And I want to look at a couple things here and kind of put them on your guys' radar. So first things first, let's go ahead and I'm going to get rid of some of these EMAs. I'm doing the weekly trend list for any of you guys. Once again, on the newsletter tomorrow morning, I'm sending out short-term, intermediate-term, and long-term trends in all of the major indexes, and you can see how week over week they kind of move around and base your plan of attack around those specific things. If you're a technical trader, trends matter, right? So as of right now, if we go ahead and turn this to a line chart and get rid of some of the candlesticks, that looks like a pretty goddamn good opportunity for a potential breakout into all-time highs coming up very soon. Once again, I want to point out, even on a line chart, if we just shift-click down, it was about a 5 to 5.5% drawdown from, we'll say, end of March through the middle of April. Not a steep drawdown whatsoever. I expected a steeper drawdown. I'll be the first to admit it. I was expecting something down here. An undercut of the all-time high pivot at 478 with a potential test of the 200-day moving average, and I had buy orders placed down here, and we just never got down there. But what I do want to point out is, we only drew down 5%, and yet if you would listen to the media or major market personalities on YouTube, for example, this was the end of the world. And I think that there's a lot of, There's a lot of alpha and there's a lot of edge. I don't want to say necessarily taking the other side of the trade because contrarians get destroyed all the time. And I love, people, I'm a contrarian. That's because you're probably an asshole in real life. It's not going to translate over into performance in the market all the time. Sometimes it does. A lot of times it doesn't. Trading against the trend can be very, very difficult way to make money in the market. But one thing I will say is the market drew down about 5.5%, but it felt way worse. If you were holding long positions, myself included, it felt really, really bad, particularly towards the end of the drawdown. It felt like, holy shit, what am I doing here? Am I doing the right thing by holding these positions? Am I doing the right thing by expecting to buy relatively soon? Like, am I looking at the right things in the market, the dollar and the bonds? Or is the dollar stop? Has it peaked and is it going to potentially come down? Have bonds bottomed and potentially catch a bid? Like all of this stuff moving, and day by day it just felt like, oh my god, maybe I'm wrong. And I can't say it affirmatively until we break into all-time highs, but I do think that was the bottom, and I do think we played it reasonably well inside of TTI. And for some of you guys watching the YouTube content every single day who've reached out to me that said you were playing it cautiously through that April 19th pivot and you're buying again, congratulations. If we're at all-time highs this week, which by the way, I think there's a real opportunity. If we look at the dollar right now, previous support level acted as resistance on Thursday and Wednesday. It does look like we're potentially heading back down towards a test of the 200-day moving average in the dollar. And if that happens, I think that's a perfect recipe for all-time highs. Guys, right now, if we go back to the S&P 500 and we look at this really quick, right now, it's obviously Sunday night here, so we're about 0.5% away. I have no idea where we're going to open up in futures in about 40 minutes, but we're about 0.5% away from all-time highs already. Is there a realistic chance that we're at all-time highs this week? Yeah, mathematically, it absolutely could happen. By no stretch of the imagination. As a matter of fact, 1 ADR is 1.15%. We're within 1 ADR away from all-time highs. It could happen. The Qs, on the other hand, have a little bit more to go. All right. We were just talking about financials, which we'll talk about again. But there are sectors within the market that are not necessarily represented by the Qs that are really outperforming right now. And that's going to help SPY catch that all-time high. I think first, that's what we're guessing, and that's where our money is right now. We're obviously long tech as well, but we have cash in financials, we have cash in utilities, and you're going to look at those positions in a sec, at least a couple of them. We're about 1% away from the Qs, but still 1.51 ADR. We could be at all-time highs in the Qs as well this week. It's really realistically could happen very easily. My gut says it's going to happen, as specifically if the dollar breaks back down and continues to draw down towards that 200-day moving average. I think we'll be at all-time highs this week. Obviously we're long. So that's what we want. But until we actually hit those all-time highs, I want to hold off on celebrating that April 19th was the bottom. And you know how it goes. If I'm wrong, people are going to fucking call me out, tell me I'm an idiot. If I'm right, people are still going to call me an idiot because you know how trading works. But it is what it is. The bond market, though, if we take this back to the candlesticks, we don't want to see bonds break back down. And I do want to point out that even though we've had a pretty good run over the last 2 weeks in bonds, which has allowed the market to find a floor and start getting bought again, one thing I do want to point out is up near this 92 area is sticky. For whatever reason, the market pivots around it, and it's a very important area in bonds. For whatever reason, once again, I have no idea why, but whenever the bond market breaks down below 92, it just seems like the equity market really shits the bed. Like seriously, it freaks out, goes into panic mode. It happened back here, happened back here. Does this act as potential resistance now? From a TA standpoint, I would expect, there's a little bit of confluence there with the 200-day moving average. If we break back over that, I'd feel a lot better. Just want to point out it's happened in the past, so we're not out of the woodwork, but I would feel better. I would feel even better if we were able to actually place a higher high in bonds. If we're all the way trading up here in the bond market, though, we're at all-time highs in the equity world. There's no ifs, ands, or buts about that. But right now, going back to Friday's bond market closed 0.56, TLT down 0.56 here. Once again, what we want to see is bonds. They don't necessarily have to rip and go parabolic, but we definitely don't want to see them start breaking back down. Hopefully, we want to see the RSI hold above the 50 here and give the equity market an opportunity to continue to rally. So, once again, we are risk on. We have been buying for the last 10 days. Did we just buy the top? I have no idea. But I'm going to point out a couple different areas of the market that we are long and we really like right now. And I think there's an opportunity for you guys to join us in this area of the market, particularly finance. Nobody is talking about finance because it's not sexy, right? It's not tech. It doesn't have Google and Meta and Microsoft and Apple. And, it has JP Morgan and Wells Fargo and Charles Schwab, and just companies that you don't think of as the leading stocks in the market realistically at all. But what happens if I told you financials have outperformed since August of 2023? They're the number one performing sector group going back to August of 2023. And financials, are right there at all-time highs. Once again, we're holding, I told you in a previous video, I think on Thursday, anything up and over their previous cycle highs. So for financials 41, if we're above 41, we want to be long again. It's just that, it's that easy for us. It's a line in the sand. The path of least resistance in my eyes above 41 is going to continue to go up more so than down. We have the beginnings of another bullish momentum regime, and we have a bunch of stocks within the financial space, the sector, actually really starting to outperform here. JP Morgan, a position that I have a very large position in JP Morgan off of the 170 area breakout. This has been a fantastic trade for us. We have Charles Schwab position, which is doing all right. We grabbed it off of the 73 pivot. We have a Wells Fargo position, which we added into. We originally grabbed it off of the 48.5 and then added in here prior to earnings. By the way, Wells Fargo, although it's not an absolute all-time high, I do want to point out that if you look back at the volume here in 2018, there is essentially nothing up here. So I do think that Wells Fargo, even though it's not an all-time high right now, it will move like an all-time high. This is a good trade for us. We're up well over 100% in the most recent ad. And then back down here is multiple hundreds of percent. Wells Fargo continue to break out. I think this is going to be a very big winner for us. Citigroup is another position that we had at one point. I think we still have small exposure in it, 53.50 area pivot. You can see generally a lot of these stocks look the same. They broke out up and over some sort of horizontal resistance area. And as long as you've been able to hold on through some of the nastier pullbacks, the 5 to 6, 7% pullbacks in banks, you have a very big win here now coming into a potential all-time high run once again in financials. And we do think it's going to happen. So we reloaded a bunch of bank stocks maybe 2, 3, 4 weeks ago during the corrective phase because financials were holding on a lot better than some of the higher risk areas of the market. And those trades right now are coming to fruition, right? And I think that's important. We don't buy and expect a win right away. As a matter of fact, here's a trade that we're in right now that is taking its sweet time. We bought it above 1150. We're stopping out below 975 as of right now. This trade is around break even or slightly down on the options contracts, but we're fully expecting this to continue to go up over time. And we have another 8 months, I believe, 7 months on the contract. So there's really no reason to worry about that. But that's what TTI is about. We want to own strength in the market and give it enough time to continue to work, right? So we're in financials. I told you we were in CEG as well. So this is what utilities looks like, just so you're fully aware. Everyone's freaking out about this. Totally understandable. We're in CEG here. We've been in CEG multiple times since the IPO originally broke out way back here. Obviously, I would be bragging if we still had our original position on CEG. We don't. But we have been able to add in the most recent ad here at that 193 area pivot. This stock is just absolutely fucking flying. This is a utilities-based stock that's listed in the Qs, right? That's all I got to say. This thing trades like a monster. It's a 3.28 ADR. You're not going to find very many utilities-based names that trade with that type of volatility. Check out VST, by the way. Another one of these trades that we were looking at back in 2023. Now, we took VST way back in 2023, but we did not hold on to the whole position move. We got stopped out based off of time on contracts a long time ago. We failed to re-enter. As a matter of fact, this was a chart that I hadn't really paid a whole lot of attention to up until the last 3 weeks when people started freaking out about utilities maybe outperforming. Look at this move. And this is part of the reason why I'm telling you that maybe utilities is not necessarily this risk-off type of idea that people are screaming about. These are companies that might be the next future or energy leaders, future energy leaders specifically for this AI bubble. This is a friggin' insane chart. I wish we were able to hold on to that original position. But once again, I'm not freaking out about utilities really starting to outperform here. I think that this is awesome. I think that's great. Last thing I want to talk about really quick was a call that I made at the end of last week that we were looking at potentially getting into semis. So we did. We started buying some semis, and I want to show you one in particular. And I'm going to talk through the thought process here because there's still time to potentially take the trade if you want it or laugh at me if you don't. I don't care either way. So semis, right? Semis have almost all recovered their drawdown going back to the middle of April, right? The big move down here to April 19th where semis capitulated. We've seen an incredible move back to the upside. As a matter of fact, some of the market leaders here like NVIDIA they don't look great like we want to own it right here, but they've recovered essentially the entire pullback, which is fantastic. We like that. That's relative strength and absolute strength. But here's our idea in semiconductors. Because of the recent absolute and relative strength from the semiconductor industry group as a whole, and not necessarily NVIDIA is reporting, right? NVIDIA reports on May 22nd. And we talked about this at the end of 2 weekends ago that maybe if it was time to start buying, we'd want to start buying some semis with the NVIDIA run-up coming up potentially. And then ARM reported and gapped down. And this is what really solidified it for us. ARM reported, gapped down, and then we saw how ARM responded the very next day, and we said, okay, it looks like we need to be buying semiconductors again. If you look at the response, ARM got bopped, but immediately right back up. That's information for us. The market could have easily sold ARM back down, and yet it didn't. It bought every goddamn share it possibly could, and it's right back up to where it was prior to earnings. And so for us, that's a signal. We don't know if it's going to turn into a long-term signal, but we want to own semis with the anticipation that the market is going to continue to run, potentially hit all-time highs, and we have a 2-week window now before NVIDIA reports to get some free trades on the books within the semiconductor space. What do I mean by that? I mean we want to own some semis that have some space to the upside to run, and then hopefully get them at 100% or more in profit, cut half of them to remove all risk from the trade, and then have the opportunity to hold through the NVIDIA earnings with completely free contracts because we've already taken half of the trade out. This is the thought process. I don't know if it's going to work perfectly, but we already started taking this trade, and at least the first trade we took, it did work. I'm going to show you it in a second. But the idea here is that if NVIDIA moons the market, which I have no idea what NVIDIA earnings are going to do. If there's anything I can tell you right now about this earnings cycle, it's that nobody fucking knows what is going to happen. We've had some insane beats get killed. We had some big misses get bought. It's just all over the place. So, NVIDIA, when they report on, May 22nd, if we have some free plays and NVIDIA moons the market, we're going to have grand slams. These things are going to be worth multiple hundreds of percent, potentially could turn into 1,000% winners because if NVIDIA moons, the assumption is the entire semiconductor industry moons and probably the market with it. That's kind of what we're going for. If NVIDIA doesn't moon and it breaks down, we're going to lose on the contracts that we have, probably almost all of the premium on them, but we have zero account capital risk because we're going to be able to take half out at 100%. So it's essentially a free lottery ticket. If you want, you can take profits prior to NVIDIA's earnings. If you're up relatively large, totally fine. But the goal is to try to get free trades ahead of NVIDIA in this event, the fat tail event that it moons the market. We want to be free with no risk on the account and an opportunity to hit a grand slam. So let me talk through the trade that we took really quick because it worked. And whether or not it works in the long run, I have no idea. But it worked in the short term, so we now have a free trade here. And obviously people are going to make fun of me on this video because everybody hates me for some reason. That's fine. Let's talk through it. We opened up TSM, and you can see kind of what we were looking for. The September 165s was the kind of the play that we wanted. And it started to work almost immediately there, but you can see the play, you can see the chart, you can see what we were looking at. We wanted to be long above, we wanted to be long TSM as long as we were above 138. So let's actually look at it on a chart here. So we bought these on the Thursday and the Friday morning, and you can see the big gap up in TSM. This was actually almost an all-time high close. As a matter of fact, let's see, we closed at 149.20. This was an all-time high close in TSM on Friday. I have absolutely no reason. There was no rhyme or reason why we talked or why we wanted TSM more than any of the other plays other than we were at the previous pivot spot, all right? We had a tight stop loss on the books, and there was options liquidity on the chain. The fact that TSM gapped up and ran 4.53, completely irrelevant to the trade idea, but guess what? We were able to grab it with the underlying assumption that semis were going to run, and this is the immediate move. We got a 52% win in one day off of an August 160 call. You can see that we got a TSM, so 6 debit spreads. He's able to close half of those. And now he has a free trade on there. We can see TSM, the June 160 call, up 107 right off of market open. This is what we were gunning for, though. This is the whole idea. I have no idea if this particular ticker is going to run, and I have zero opinion on whether or not NVIDIA is going to do well. The whole idea is we want to have a position on the books with no risk heading through the earnings, because if it does end up mooning, this TSM position is going to go from maybe 100 to 200% at the time of NVIDIA to maybe 1,000%. I have no idea where it could potentially go. And like I said, if it doesn't work, we have no account capital risk because we already took half out. So that is the thesis. We are buying. You should sign up for the newsletter below, once again, if you're not already on it, because tomorrow I'm sending out a scan with the 30 stocks, 30 largest stocks that are showing strength within the U.S. market alone, so no international stocks. And I talk about stuff like this all the time, what we're doing, not specifically the stock tickers. That's for paid members only, right, guys? But seriously, you can have a general idea of what we're doing almost on a day-to-day basis because I send these emails out every single day. Guys, my name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe. Let me know what you think in the comments below. Are you buying? Is this risk on? Do you think we're going to be at all-time highs relatively soon? Do you think that this is the top and we're about to break back down? I have no idea any more than the guy next to me. All I know is my money is long, and right now it's working. I'll catch you in the next video.